Before we begin today's analysis, a brief word. If you value disciplined, thoughtful financial insights grounded in market history and rational strategy, please consider subscribing to this channel. Click the subscribe button below in red. We focus on education, not entertainment, preparation, not promises. Now let's proceed. Something is shifting beneath the surface of the silver market. Not the kind of shift that makes headlines overnight, not a social media frenzy or a speculative fever dream. This is structural, fundamental, and it's unfolding with the slow, methodical force of plate tectonics. You hold PSLV. Perhaps you've held it for months, perhaps years. You've watched the price oscillate. You've endured doubt. You've questioned your thesis during stretches of silence when the market seemed indifferent to every reason silver should rise. But now, three forces are converging. War is escalating in regions that matter to industrial supply chains. Silver inventories are contracting at rates not seen in over a decade, and price levels near $94 per ounce, levels that once seemed distant, are being discussed by institutional analysts with increasing seriousness. This is not a prediction. This is not hype. This is an examination of conditions that demand your full attention. Over the next 25 minutes, we will walk through what these conditions mean, how they interact, what mistakes could destroy your position even if the thesis proves correct, and what disciplined action looks like at this critical juncture. This conversation is for serious investors, not gamblers, not speculators chasing momentum. If you're here for quick thrills, this is not your video. The silver market has always been complex. It sits at the intersection of monetary history and industrial necessity. It behaves like a commodity until it doesn't. It trades like a metal until geopolitics reminds everyone it's also money. Right now, three separate forces are pressing against this market simultaneously. First, geopolitical instability. War is no longer theoretical. Conflicts that involve major industrial powers create supply chain disruptions. They create energy shocks. They create demand for safe haven assets. And they create uncertainty that forces institutional capital to reconsider assumptions. Silver mining is globally distributed, but refining and supply chains are concentrated. When nations that process silver face infrastructure stress, bottlenecks form. When trade routes become uncertain, just-in-time delivery models fracture. This is happening now, not in hypothetical future scenarios. Now. Second, supply dynamics. Above-ground silver inventories held by exchanges and dealers have been declining steadily. This is not a one-month anomaly. This is a multi-year trend that has accelerated recently. Industrial demand remains robust. Solar panel production, electric vehicle components, electronics manufacturing. These are not discretionary sectors. These industries consume silver whether prices are $25 or $50 because substitution is difficult and often economically impractical. Meanwhile, mine production has plateaued. New discoveries are rare. Lead times from discovery to production span years or decades. The easy silver has been extracted. What remains requires higher costs, longer timelines, and increasingly complex operations. Third, price levels that were once considered theoretical resistance are now being treated as plausible near-term scenarios by analysts who do not engage in sensationalism. $94 per ounce is not a meme. It's not a fantasy target invented by internet forums. It's a level derived from supply-demand modeling, inflation-adjusted historical precedents, and macroeconomic stress tests. When serious institutions begin discussing such levels publicly, something has changed in the underlying calculus. These three forces, geopolitical stress, supply contraction, and institutional repricing, are not independent variables. They reinforce each other. They create feedback loops. And once such loops begin, they can accelerate faster than markets expect. Let's be clear about what you hold when you hold PSLV. PSLV is the Sprott Physical Silver Trust. It is not a derivative. It is not a promise. It is not paper silver that exists only on ledgers. PSLV holds physical silver bullion in secure vaults. Each unit represents a fractional ownership of actual metal. This distinction matters enormously. During periods of financial stress, the difference between physical-backed assets and paper claims becomes stark. History offers examples. In 2008, counterparty risk destroyed positions that looked safe on spreadsheets. In 2020, futures markets experienced dislocations that revealed the fragility of certain derivative structures. PSLV was specifically designed to eliminate these risks. The structure is transparent. The audits are regular. The metal is allocated. You're not exposed to the rehypothecation games that plague certain other vehicles. But physical backing does not mean immunity from volatility. It does not mean your position is guaranteed to appreciate. It means you own what you think you own. That's all. That's enough. If you've chosen PSLV over futures, over mining stocks, over unallocated pool accounts, you've made a decision rooted in risk management. You've prioritized certainty of ownership over leverage or speculative upside. That decision is about to be tested. Because as conditions intensify, volatility will increase. Price swings will widen. Your conviction will be challenged not by the failure of your thesis, but by the emotional turbulence of watching dramatic movements day to day. Understanding what you own, truly understanding the structure and purpose of your position, is the foundation that will keep you anchored when markets become chaotic. Silver has experienced multiple bull markets in modern history. Each was driven by distinct catalysts. Each exhibited specific behavioral patterns. And each ended with lessons that most participants failed to learn. The Hunt Brothers era of the late 1970s saw silver surge to $50 per ounce. That episode was driven by speculative accumulation combined with inflationary macroeconomic conditions. It ended in dramatic collapse when leverage unwound and regulatory intervention altered market structure. The lesson was not that silver cannot rise. The lesson was that excess leverage destroys positions even when the directional thesis is correct. The 2008 to 2011 cycle saw silver climb from single digits to nearly $50 again. This move was driven by quantitative easing, sovereign debt concerns, and a broad commodities bull market. It attracted massive retail participation, much of it driven by fear of currency debasement. The subsequent decline was brutal. Silver fell over 70% from its peak. Many who bought at elevated levels exited at losses, exhausted and disillusioned. The lesson was not that precious metals are poor investments. The lesson was that timing, position sizing, and emotional discipline determine outcomes as much as directional accuracy. Now, in 2026, we face a different configuration. The current environment combines elements of both past cycles, inflationary pressures reminiscent of the 1970s, and monetary policy extremes reminiscent of the 2008 era, but with additional factors neither period faced. Global debt levels are exponentially higher. Geopolitical fragmentation is accelerating. Supply chains are less resilient, and physical demand from industrial sectors is structurally embedded in technologies that define the modern economy. History does not repeat, but it rhymes. The patterns of investor psychology remain consistent, the oscillation between greed and fear, the tendency to capitulate at bottoms and overcommit at tops, the failure to plan for volatility, even when volatility is predictable. If you study past cycles not for price targets but for behavioral patterns, you gain an advantage that most participants never develop. Let's address the supply side with precision. Silver mine production is approximately 830 million ounces annually. This number has been relatively flat for several years, despite price increases that should theoretically incentivize new production. Why? Because silver is predominantly a byproduct of other mining operations. Roughly 70% of silver comes from mines primarily extracting copper, lead, or zinc. Primary silver mines are less common. This means silver supply does not respond to price signals the way simple economic models suggest. Even if silver prices double, you cannot simply turn on new supply. The decision to expand a copper mine is driven by copper economics, not silver. Industrial demand consumes approximately 600 million ounces annually. This includes solar panels, electronics, medical equipment, and increasingly electric vehicle components. This demand is inelastic. A solar panel manufacturer cannot simply reduce silver content by 50% if prices rise. The engineering requirements are fixed. The alternatives are either inferior or non-existent. Investment demand varies. During periods of macroeconomic stability, investment demand is modest. During periods of crisis or currency concern, investment demand can spike dramatically. The critical point is this: the market is already tight. Inventories are declining. Industrial demand is structural. And investment demand has not yet surged to levels seen in previous crisis periods. When investment demand does surge, and historically it always does during periods of geopolitical and monetary stress, the supply available to meet that demand is limited. This is not speculation. This is arithmetic. The registered silver inventories at COMEX have fallen significantly. ETF holdings in certain vehicles have declined, but in others, like PSLV, they have remained stable or grown. This suggests a bifurcation between weak hand selling and strong hands accumulating. Meanwhile, industrial users are securing long-term supply contracts. They are not waiting for lower prices. They are prioritizing availability over cost optimization. These behaviors signal what sophisticated market participants see but do not always discuss publicly. Supply is becoming a constraint that price must eventually resolve. Markets are reasonably efficient at pricing known variables: interest rates, earnings reports, inventory data. Markets are terrible at pricing geopolitical tail risks until those risks materialize. War and conflict introduce non-linear outcomes. They disrupt supply chains in ways that cannot be modeled with precision. They create sudden shifts in capital flows as investors flee perceived danger zones. Currently, tensions involving major powers are elevated. Without speculating on specific outcomes, we can observe that the probability distribution has shifted. The tail risks are fatter. The confidence intervals are wider. Silver responds to geopolitical stress in two ways. First, as an industrial input. If conflicts disrupt mining operations, refining capacity, or transportation routes, physical availability becomes constrained. Prices adjust to ration scarce supply among competing users. Second, as a monetary asset. During periods when confidence in fiat currencies or financial institutions wavers, investors rotate toward tangible stores of value. Gold receives primary attention, but silver benefits from the same dynamic, often with greater percentage moves due to its smaller market size. The current escalation is not occurring in isolation. It coincides with fiscal strains in major economies, central bank policy uncertainty, and questions about the sustainability of sovereign debt levels. This combination creates conditions where silver's dual nature, industrial commodity and monetary metal, both support higher prices simultaneously. You cannot predict exactly when geopolitical events will trigger market responses, but you can position for a range of outcomes. You can ensure that your portfolio is not fragile to scenarios that, while uncertain, are no longer implausible. PSLV holders have already positioned for such scenarios, consciously or not. The question now is whether you have positioned appropriately, whether your position size matches the conviction of your thesis, whether you have planned for volatility, whether you have defined exit criteria or hold criteria in advance. Because when events accelerate, decision-making becomes emotional. Plans made in calm prevent mistakes made in chaos. Let's talk about the $94 figure directly. This is not a price target. This is not a guarantee. This is a scenario analysis based on specific assumptions about supply constraints, investment demand, and inflation-adjusted historical precedents. If silver were to reach the inflation-adjusted equivalent of its 1980 peak, depending on the inflation calculation methodology used, the result ranges from approximately $85 to $120 per ounce. If silver were to reach the inflation-adjusted equivalent of its 2011 peak, the result is approximately $70 to $85 per ounce. $94 sits within this range. It represents neither the most conservative nor the most aggressive scenario. Several institutional analysts have published research discussing this level, not as hype, not as entertainment, a sober analysis of what supply-demand imbalances could produce if specific conditions materialize. What conditions? Continued industrial demand growth, no major new supply sources, sustained or accelerating investment demand driven by inflation, concerns, or geopolitical hedging, central bank policies that maintain negative real interest rates. None of these conditions are guaranteed, but none are far-fetched. Most are simply extensions of trends already in motion. Here is what matters. Whether silver reaches $94 or not, the direction of travel is more important than the destination. If silver moves from current levels towards $60, your PSLV position appreciates significantly. If it moves to $75, more so. The specific upper bound is less important than recognizing that the risk-reward at current levels favors those positioned for upside. But, and this is critical, the path will not be linear. There will be corrections. There will be periods of sideways consolidation. There will be moments when headlines scream that the move is over, that silver has topped, that you should sell. This is where most investors fail, not because their analysis was wrong, because they could not tolerate the volatility required to realize gains. The $94 discussion is useful not as a target, but as a framework for thinking about potential magnitude. It calibrates expectations. It reminds you that significant moves are possible, and it reinforces the need for discipline during the inevitable turbulence. Your decision now is not whether silver is a good investment. Your decision is whether your current position is appropriate, given changed circumstances. Let's think through this systematically. First, review your position size. Does your PSLV allocation represent a thoughtful percentage of your portfolio, or did it grow through appreciation to become overweight? There is no universal correct allocation, but there is a relationship between position size and emotional resilience. If your silver position is so large that daily price movements cause anxiety or sleep loss, it's too large. If it's so small that meaningful price appreciation wouldn't materially improve your financial situation, it may be too small. Second, clarify your time horizon. Are you holding PSLV as a short-term trade based on recent momentum, or as a multi-year position based on structural themes? If your horizon is short, you are trading, not investing. That's neither good nor bad, but it requires different decision rules. You need to find exit points. You need to monitor technical levels. You need to be prepared to act quickly. If your horizon is long, recent volatility should be irrelevant noise. Your focus should be on whether the underlying thesis remains intact, not on whether the price rose or fell this week. Third, assess your liquidity needs. Do you have sufficient cash reserves for emergencies, or is your PSLV position part of your liquidity buffer? PSLV is liquid in the sense that it trades on exchanges with reasonable volume, but it is not cash. During market stress, bid-ask spreads can widen. During personal stress, being forced to sell into weakness destroys wealth. If your position is appropriate in size, time horizon, and liquidity context, the decision is straightforward. Hold, do nothing. Let the thesis unfold. If any dimension is misaligned, adjust now, not after prices have moved, not when emotions are heightened. Now, in a period of relative calm. Fourth, consider whether to add to your position. This is the most difficult decision. Adding to a winning position feels uncomfortable. You worry about buying at the top. You remember stories of investors who doubled down just before crashes. But if your analysis suggests conditions have strengthened, if supply is tighter than when you first invested, if geopolitical risks are higher, if institutional interest is growing, then adding at higher prices is not chasing. It's responding to improved probability distributions. The key is to add incrementally, not all at once, to dollar cost average into strength, not to go all in at a single point, and never, ever use leverage. The leverage trap has destroyed more silver bulls than any price decline ever has. Finally, plan for volatility. Silver can rise 50% in months, then fall 30% in weeks. This is normal. This is the asset's character. If you cannot tolerate such movements without panic, reduce your position to a level you can tolerate. Better to hold a smaller position through the full cycle than to hold a larger position that you abandon at the worst possible moment. Your goal is not to maximize theoretical gains. Your goal is to maximize realized gains after accounting for your actual behavior under stress. Perhaps you don't hold PSLV yet. You're watching. You're researching. You're trying to determine if now is the time to establish a position. This is a harder question than it appears. Everyone wants to buy at the bottom. Everyone wants perfect timing. Everyone wants the confidence that comes from entering just before a major move. That confidence is a fantasy. No one knows where the bottom is until it's in the past. No one can guarantee that today's price won't be lower tomorrow. What you can assess is whether the risk-reward is favorable, whether the potential upside justifies the potential downside, whether the thesis is sound enough to warrant committing capital. Let's be direct. Silver is not cheap by historical standards. It's not trading at multi-year lows. It's not hated and forgotten. There is already significant interest, significant awareness, significant positioning. This means the easy gains, the gains available to those who bought in periods of maximum pessimism, are likely behind us. But easy gains and substantial gains are not the same thing. If silver moves from current levels to $70, $80, or $90, those who entered at these prices will still profit significantly. The question is not whether you're buying at the absolute bottom. The question is whether you're buying before the move that matters. If you believe supply constraints are real, if you believe geopolitical risks are underpriced, if you believe monetary debasement continues, then current prices may represent reasonable entry points for long-term positions. But you must enter with discipline. Start with a small position, perhaps 5% of your intended allocation. Watch how you feel as prices move. Observe your emotional responses. Do you panic when prices drop? Do you get greedy when prices rise? Do you check the price compulsively? These reactions reveal your true risk tolerance, which is almost always lower than your theoretical risk tolerance. If you can hold that initial position calmly through daily volatility, add to it incrementally. Build the position over weeks or months, not in a single transaction. This approach sacrifices the possibility of perfect timing, but it reduces the risk of catastrophic timing. It allows you to average your entry across multiple price points, and it keeps you in the game psychologically. Remember, the biggest risk for new investors is not entering at a poor price. The biggest risk is entering with too much capital, too much conviction, and too little preparation for volatility, then exiting in panic at the first significant correction. You're better served by a smaller position held with discipline than a larger position abandoned in fear. Also, be realistic about opportunity cost. Capital allocated to PSLV is capital not available for other opportunities. Silver may rise significantly, but if you're fully invested in silver and a superior opportunity emerges elsewhere, you've created an opportunity cost. Diversification is not cowardice. It's rational risk management. If you decide to establish a PSLV position, do it for the right reasons. Not because a video excited you, not because social media is buzzing, not because you fear missing out. Do it because you've studied the supply-demand dynamics, because you understand the geopolitical context, because you've assessed your personal risk tolerance and time horizon, because you've decided this asset deserves a place in a diversified portfolio. And then, commit to the position. Not with blind faith, but with informed patience. Let's talk about what destroys investors even when their thesis is correct. Mistake 1. Emotional trading. Buying when fear is highest, selling when euphoria peaks. Reacting to daily news, making decisions based on how you feel rather than what you know. The silver market will test your emotions repeatedly. Prices will spike on dramatic headlines, then collapse on profit-taking. Commentators will declare new bull markets, then predict imminent crashes. If you react to each fluctuation, you will be whipsawed into losses regardless of the long-term direction. Discipline means establishing decision rules in advance and following them mechanically. It means checking prices infrequently. It means ignoring the noise that is designed to provoke reaction. Mistake 2, over-leveraging. Using margin, options, or leveraged ETFs to amplify gains. Leverage magnifies returns in both directions. It can turn a modest decline into a catastrophic loss. It can force liquidation at the worst possible time. The silver bulls who suffered most in past cycles were not those who held physical or unleveraged positions. They were those who used leverage, who faced margin calls, who were forced to sell into panic. If you're tempted by leverage because your position seems too small to generate meaningful wealth, your position is exactly the right size. Seeking leverage signals greed overriding prudence. Mistake 3, failing to take any profits. Riding a position from bottom to top and back to bottom again because you believe it will go higher forever. There is no shame in taking partial profits along the way. If silver doubles, selling 10 or 20% of your position to rebalance, to realize gains, to reduce emotional pressure is rational. You are not required to hold every ounce through the full cycle. Taking some profits at strategic levels can fund other opportunities, provide psychological relief, and ensure you realize some gains even if the top is unpredictable. Mistake 4, failing to take any profits ever. The opposite mistake. Selling too early because of fear, because of impatience, because you cannot tolerate volatility. The balance is difficult. There is no formula. But thinking about it in advance, defining rough levels where partial profit taking makes sense, removes the emotional burden when those levels arrive. Mistake 5, listening to commentators who promise guaranteed outcomes, who claim to know exactly where silver is going and exactly when, who use certainty as a marketing tool. No one knows. Not the most credentialed analyst, not the most confident YouTube personality, not the person who called the last move correctly. Markets are probabilistic. Outcomes are uncertain. Anyone claiming certainty is either deluded or dishonest. Your job is not to find certainty. Your job is to position for a range of probable outcomes, manage risk across that range, and adapt as conditions change. Mistake 6, ignoring tax implications. Realizing that after a significant gain, the tax burden reduces your net return substantially. This doesn't mean you should never sell. It means you should be aware, should plan, should consider tax-advantaged account structures if available, should consult professionals rather than making decisions in ignorance. Mistake 7, becoming ideological. Believing that silver must rise because of some fundamental principle of justice, monetary history, or economic inevitability. Markets do not care about ideology, they care about supply and demand. They can remain irrational longer than you can remain solvent. Hold silver because the risk-reward is favorable, not because you've adopted it as a worldview. Maintain intellectual flexibility. Be willing to exit if conditions change fundamentally. Mistake 8, isolation. Making decisions alone without perspective from others who think seriously about markets. You don't need to follow the crowd, but complete isolation can lead to echo chambers of your own making, where your biases are never challenged, where your assumptions are never tested. Seek out intelligent people who disagree with you, and listen to their reasoning. You may still hold your position, but you'll hold it with greater awareness of the risks. These mistakes are not theoretical. They are patterns repeated across market cycles, across asset classes, across generations of investors. You're not immune to them by virtue of intelligence or education. You're only protected by awareness, by planning, and by discipline. So where does this leave you? You now understand the forces converging on the silver market. You understand what PSLV represents. You understand the historical context, the supply dynamics, the geopolitical variables. You understand the mistakes that destroy investors and the behaviors that preserve capital and capture gains. But understanding is not enough. Knowledge without action is theoretical. Action without discipline is dangerous. The path forward requires several commitments. First, commit to reviewing your position intentionally, not reactively. Set a schedule, once per month perhaps. Not daily, not hourly. Assess whether your thesis remains intact, whether your position size remains appropriate, whether your risk management is functioning. Second, commit to ignoring short-term noise. Daily price movements are information-free. Weekly narratives are designed to generate clicks, not insight. Focus on the structural variables that matter. Supply data, industrial demand trends, monetary policy direction, geopolitical developments. Third, commit to maintaining cash reserves. No matter how compelling silver appears, no matter how certain the thesis seems, maintain liquidity. Opportunities arise unexpectedly. Emergencies occur. The investor who is fully invested is fragile. Fourth, commit to emotional honesty. When you feel fear, acknowledge it. When you feel greed, recognize it. These emotions are not failures, they're signals. They indicate when you're at risk of making mistakes. If fear is overwhelming, reduce position size until calm returns. If greed is driving decisions, step back until clarity returns. Fifth, commit to patience. The thesis may take years to fully unfold. Silver may move sideways for extended periods before breakouts occur. Your capital is committed. Your opportunity cost is real. Impatience will not change the timeline. Sixth, commit to learning continuously. Markets evolve. New information emerges. Your understanding should deepen over time, not ossify into rigid beliefs. Seventh, commit to humility. You may be wrong. The thesis may be invalidated by developments you cannot foresee. Holding this possibility in mind prevents catastrophic attachment to losing positions. This is not pessimism. This is realism. The best investors hold strong convictions loosely. They commit capital while remaining open to revision. The current environment presents unusual opportunity. The convergence of supply constraints, geopolitical stress, and monetary policy extremes creates conditions that historically precede significant moves in precious metals. But opportunity is not destiny. Many will squander this opportunity through poor behavior. Many will enter too late with too much capital and too little preparation. Many will exit too early, exhausted by volatility they should have expected. Your advantage is not superior prediction. Your advantage is superior preparation and superior discipline. If you hold PSLV, hold it with conviction, but without rigidity. Monitor the thesis, not the price. Plan for volatility, not for certainty. Take profits strategically, not emotionally. If you're considering a position, enter with discipline. Start small. Build gradually. Commit for the long term. Accept volatility as the price of participation. And whether you hold or are considering entry, remember this. The goal is not to maximize wealth in a single trade. The goal is to build durable wealth across multiple cycles, multiple assets, multiple decades. Silver is one component of that goal, not the entirety, not the guarantee. One component in a diversified approach to managing capital in an uncertain world. The fuse is lit, not because anyone can guarantee the outcome, but because the conditions that precede significant moves are present and strengthening. War escalation is real. Supply contraction is measurable. Price levels that once seemed distant are being discussed seriously. You have a position, or you're considering one. You've done the research. You understand the dynamics. Now comes the hardest part. Executing with discipline, holding through volatility, avoiding the mistakes that destroy others, maintaining emotional equilibrium when markets test your conviction. This is where investors are made or broken, not in the thesis, in the execution. You are capable of this, not because you're special, because you're prepared, because you've thought through the scenarios, because you've planned your behavior in advance. The markets will do what they do. Your job is to manage yourself, to position appropriately, to act rationally, to remain in the game long enough for probabilities to work in your favor. This is not glamorous. It's not exciting. It's not the stuff of viral videos or get-rich-quick stories. It's how wealth is actually built. Slowly, carefully, with discipline and patience and a long time horizon. The opportunity is in front of you. The risks are real. The path is uncertain. But you're not walking it blind. You're walking it informed, prepared, and disciplined. That's all any investor can ask for. That's enough. Thank you for your time and attention. Stay disciplined, stay rational, and stay prepared for whatever comes next.